formatting. So it just takes a few seconds to get that. Get that done. Right, so that's now live on YouTube. I will click start webinar and then I'll share my screen. Or, yes, right. We're now live.
Okay, welcome to today's webinar, everybody. My name is James Faulkner, and I'm delighted to welcome David Paul of VectorVest to the show. Hello, David.
Hi, James. How are you doing?
Good. How are you?
All good today. All good today.
Good stuff. I'm told that we might have a visit from a fireman at some point, so don't be alarmed if you see somebody wandering around behind David. But barring that, David is going to talk about worry-free investing for consistent growth and income using the VectorVest platform. VectorVest is a stock analysis and portfolio management system, but I think what really sets it apart from the other software packages out there is that it also gives specific recommendations, not only of what to buy and sell, but when to buy and sell. And I know from my own personal investing experience that the latter is often the most difficult. Some of you will already be familiar with VectorVest, as David has been a long-standing supporter of the Master Investor Show. David also has many decades of investing experience, both at an institutional level and in terms of managing his own money. It's also worth pointing out that VectorVest is authorized and regulated by the FCA. And correct me if I'm wrong, David, but I also believe it's the only investing software provider that's authorized to give buy and sell advice. Is that right?
To my best knowledge, that's correct. Yes, to my best knowledge, yes.
Okay, so please do keep your questions coming during the course of the webinar. We'll get through as many as possible at the end. But now I'm going to pass you over to David for the presentation. Over to you, David.
Thank you, James. Thanks, Tim. Thanks to Master Investor for having me along. It's a great pleasure and honor to be here, folks. I'm going to share my screen now. I have a PowerPoint presentation prepared, and with any luck, you can see that. Am I correct?
Yep, that's all working.
Okay, that's kind. Thank you, Tim. The first thing I have to do, ladies and gentlemen, is to put up the VectorVest disclaimer. Our customers will have seen this 1,000 times. Although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find, the sort of thing that your financial advisor will have done with you. I'm allowed to talk about those shares that I hold myself, but I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. And every Monday afternoon, I do a presentation to all our UK subscribers. We get VectorVest subscribers from all over the world, and I talk about my investments and trades in the UK, mostly in the US, and they see every last one of those, warts and all, the good ones and the bad ones. So that said, we can move on, and my objective this afternoon in the next 50 minutes is to show you how to invest with confidence and outperform the market in a few minutes a day. Now, let me clear this up because I've confused people in the past. I'm not talking about buying shares at 9 o'clock in the morning and selling them at 10 past 9. We're not talking about day trading. I'm talking about building a portfolio of winning stocks that are rising in price and managing the risk in 10 minutes a night. Just remember, ladies and gentlemen, don't avoid risk, manage risk, and it has to be managed proactively. It's real. It is risk and reward, not reward and risk. So that risk can be managed and managed in a few minutes an evening. So the objective is to show you how to retire younger with more lit than you ever thought you could by three things, folks. And the first one might seem obvious. One, capital growth. This mouse is more difficult than it looks. We want to find shares that are going to rise in price. That might seem obvious. Two, we want to look for dividends and add the dividends into the mix. Now, I have a PhD in mathematics, and when I sit down on Excel and I do those compounding calculations, I'm always impressed. Einstein said it was one of the wonders of the world. And the third thing, which is difficult in the UK, is writing what's called covered calls on the shares that you've got for extra income, and also adding that into the mix. Now, this is very difficult in the UK. That wasn't always the case. Those of you that have reasonable memories will remember that the options market on shares in the UK was very liquid 20 years ago when Life was operating. Life was in the IG building in Cannon Bridge. And the options market was very liquid in those days, but it largely died a death. Certainly even in big shares like Shell, for example, the options market is largely illiquid. So if you're in the US, my colleagues in the US regularly generate extra income by writing covered calls on the shares that they've got. In the UK, we're going to try and build wealth by 1 and 2. All right, so I suppose I really didn't need this because you're looking at me, but sometimes on our normal media on a GoToWebcast, there's no video. So that's me. I'm unfortunately pushing 66. I can't believe it myself. I've been investing in the stock markets of the world. I put on my first trade in October 1982, and I was in South Africa at the time. I emigrated from the UK to South Africa in 1981. I went there for 6 months to play professional rugby, and I stayed 35 years. And while I was there, I was working at De Beers, and I shared an office with an old fellow, and he was trading the stock market. And I watched him and I watched him and I watched him, and finally built up some cash, and I put on my first trade in October 1982. And it was a winner. It was a trade in South African breweries, or SAB Miller, or InBev as it's called now. And I traded while working at De Beers until 1988. And in 1988, I cut the corporate umbilical cord for good, and I've been trading on my own ever since. I think for the last 10 years, I've been helping people to improve their performance with the VectorVest product in South Africa, in the UK, and in the US. And I started off, I started VectorVest South Africa, and then a few years back, VectorVest asked me to come and run the UK operation. And I've been back in the UK, back home, permanently now for the last 5 years. Very happy to be here as well. And I'm presenting from sunny Notting Hill this afternoon. So what we're going to try and cover, folks, is the VectorVest system of analyzing stocks, which is what to buy. The second bit is controversial, because we firmly believe at VectorVest that there's a good time to be in the market and a really awful time to be in the market. And we have a market timing system which will tell you when it's safe to be in the market and when it's not safe to be in the market. And then what I want to try and do is to fuse that together into a mechanical, worry-free investing strategy, which is answering the third thing in James's title slide of when to sell. So what, when, and when to sell, and also how to manage the trade. On many occasions, we don't want to sell at all. We just want to let the trade move up the page and pull a stop loss up behind us, how to manage the trade. So we're going to start with the VectorVest system of analyzing stocks. Now, through the presentation, folks, I'll use the word stock and share interchangeably. They mean the same thing to me, really. So if you're in the property business, and I had some questions about property, but if you're in the property business, there's three words that are important. Location, location, location. Well, in the stock market, there's three words that are important as well, and that's earnings, inflation, and interest rates. Earnings or profits, and as Warren Buffett and his mentor, Ben Graham, says, the earnings per share is the engine that drives the share price. Inflation in the general economy, interest rates in the general economy, and those affect valuations. Now, over the last 30 years, Dr. Bart DeLito, who's the founder of VectorVest, has put together a valuation algorithm which puts a value to every share in the market every single day. Now, in his book, Stock Strategies and Common Sense, if you're quantitatively orientated, you can go to chapter 3. And in chapter 3, he'll show you exactly how he gets to that valuation number. And I'll show you how to find his book when we get into the program in a moment. So we want to know the following three things, ladies and gentlemen. What's a stock really worth? How safe is the earnings stream? And certainly for our worry-free, hands-off way of building wealth, the safety of the earnings stream is incredibly important. And I'm going to focus on that a great deal this afternoon. And then, is it rising? Is the share price going nowhere? Hold. Or is the share price falling? We want to know that. So the first two would be referred to as fundamental measures of the company. And this, of course, is a technical measure of the company. Now, if we stand back a little bit, my definition of fundamental analysis is it's a search for the true value of a share. And my definition of technical analysis, which worked for me a long time, is it's a study of trends and turning points. And at VectorVest, we want to put both together. We want to find shares and have the best of both worlds. And when I first, James, started to do work with Master Investor some years ago, I met Zach Meir at Master Investor. And Zach's a good friend of mine. And Zach says that VectorVest is the best of both worlds, the best of fundamental analysis fused with the best of technical analysis. So that's the gist. Now, I want now to think about, I think, which the number and the metric which is the most important on VectorVest is called relative value. And ladies and gentlemen, you're going to have to think for a couple of minutes and then you can relax. We'll go to the good stuff of how to make money in a second. But if I don't get this across, a great deal of the presentation won't make a great deal of sense. So relative value is an indicator of the long-term price appreciation. Now, for long-term, read 3 years. An indicator of the long-term share price appreciation potential in relation to what a corporate bond will pay in the same period. The corporate bond, AAA rated corporate bond, a measure of the risk-free rate. Relative values on a scale between 0 and 2, like everything else in VectorVest, and above 1, your share has got a high probability of outperforming what a corporate bond will pay. Now, how do we do this? Well, we forecast the earnings of every company on the LSE 3 years out. So we work out how much it's going to make 1 year out, 2 years out, 3 years out. And we do that by extrapolating from the financial statements that we purchase and also by buying an earnings forecast from the world's leading provider of such a company called FactSet. So we know with a great deal of certainty how much money it's going to make next year, the year after that, and the year after that. We make the following assumption, folks. We assume that in some time within that 3 years, not when, just within that 3-year window, those earnings will be discounted into the share price. And we work out what the share price will be. We take that projected share price and we subtract the price today to get the upside. And we divide that upside by what a corporate bond will pay in the same period. Now, it's on a scale between 0 and 2. Less than 1 is not good because the probabilities favor your share underperforming what you can get from a corporate bond. Now, if you know anything about the pecking order of how people are paid, you will know that the bondholders get paid a long way ahead of the common shareholders. So that doesn't seem like a good idea. Greater than 1 is fair. And we've found from our research, I've done it, our research department in North Carolina have done it, and many of our subscribers, including one very diligent researcher from our Guildford group, we've shown that if the RV, ladies and gentlemen, is greater than 1.25, that greatly enhances our ability, the ability of our portfolio to give us those capital gains that we require to become wealthy. So the very first requirement, ladies and gentlemen, of our worry-free investing strategy is that the share must have a relative value of greater than 1.25. Now, relative value is an amazing calculation because it solves an incredibly important investment problem. And that problem is it better to buy a share on a price to earnings ratio? In other words, the share price divided by how much money it makes of 50, or a share that's on a PE of 5. Now, PE looks back. It looks at history. And at face value, you may say to yourself, well, if I'm buying a share at 5 times earnings, that's much better than buying a share at 50 times earnings. 50 times earnings looks incredibly expensive. But ladies and gentlemen, if a share on 50 times earnings is growing earnings strongly, then that share could be cheap at 50 times earnings. And Amazon and Facebook and a whole host of them have proved that. And similarly, a company on a price to earnings ratio of 5 could be incredibly expensive at that level if the earnings are falling off a cliff. Now, this was brought home to me recently by a good friend of mine in South Africa, who was a large fund manager for a LSE listed company. And he left to start his own little boutique investment shop. And he fell in love with the share, an engineering company on a PE of 5. That's why I use the number. And he kept buying more and more and more of it because it was cheap. There was a good reason for it being cheap, ladies and gentlemen. The earnings were falling off that very same cliff. And 2 or 3 months after he bought into it for the nth time, it went bankrupt. And he lost his asset management company because I assure you, if you're managing money for somebody else and one of your biggest investments goes bankrupt on you, the rest of your clients will say to themselves, have we got a loose cannon here? And they run for the door. That's exactly what happened to him. So relative value answers that age-long question. Is it better to buy a share on a PE of 50 or 5? If the RV is high on a share on a PE of 50, then it's a good buy. So for our worry-free strategy, I want RV to be greater than 1.25. Now, the next number is incredibly important for our hands-off method of building wealth without a great deal of angst. And I have to apologize profusely for the rugby metaphors. My rugby coach used to say, let the ball do the work. So what we're trying to do here is we're trying to let the share do all the work. And relative safety is very important. And the consistency and the predictability of the financial performance. Now, in relative safety, folks, it's an exact number because this looks back. So what Dr. Toledo's algorithm does is it looks at the balance sheet, the income statement, the cash flow statement. It looks at margins, expanding hopefully, or contracting, sales, dividends, dividend safety, dividend yield, and all those ghastly financial ratios. And I'm still a mechanical engineer, folks, okay? I have a degree in engineering, MSc in metallurgy, PhD in applied mathematics. I have no formal financial training apart from what I had to do to become authorized by the FCA. So those financial ratios are still a headache for me. VectorVest does all that for me. And it gets us one number, again on a scale between 0 and 2, which in fact measures the consistency and the predictability of the financial performance. Now, less than 1 is not good. This is a company with a very patchy track record. Now, that could be a great company, folks, for swing trades. Okay, it could be, there could be some wonderful moves there, but because the share has dropped the ball so many times in the past, it's not appropriate for hands-off, worry-free investing. Greater than 1 is okay. And folks, again, if you get a RS of 1.25 or right up to about 1.5, that's a company that's making money. And all those financial ratios are getting better. It invariably pays a dividend and has got a history of growing that dividend safely. The dividend cover is good. It's not borrowing money to pay the dividend. So in our worry-free trading strategy, folks, I'm looking for the shares with the highest relative safety that have also got the ability to grow. Now, these are very special animals, and there's not that many of them on the LSE. Many more in the US market because there's 5 times as many shares, but very special animals indeed. Companies that have got the ability to grow their earnings strongly and have got a proven track record of safety. That's what we're looking for. Let the ball do the work. Now, the third metric is relative timing. And this is a technical measure. Remember, technical analysis, the study of trends and turning points. And this is a technical measure which measures the direction and the strength of the price trend. And, it's quite simple, 0 to 1, less than 1, the darn thing is falling. Greater than 1, it's rising. And the further above 1, the faster it's rising. So it measures both the direction of the price and the strength of the trend. And then what Dr. Toledo did is that he put together relative value and relative safety, which are fundamental measures of the share, with relative timing, which is a technical measure of the share, into the master indicator VST. And as a default, all of the shares on the LSE are actually sorted by VST. As you'll see later in the presentation, for our worry-free trading strategy, I've actually decided that we're going to sort all of the shares by relative safety to bring the safest ones to the top. Now, if I were doing a webcast on swing trading, then the VST sort is the most appropriate. But I'm not. I'm doing a worry-free investment seminar. And we've found, and I've found, and our customers have found, that the RS sort with a share that's growing earnings strongly, RV greater than 1.25, produces exceptionally good results with very, very little effort. If I were managing your money, ladies and gentlemen, and I've managed a lot of money in my time, that's why I've got no hair. If I were managing your money, I would put 80% of it into this technique, and with the rest, I would in fact do some swing trading. Okay. So we calculate a stop loss for every share in the market every single day. Now, risk is real. It is risk and reward. We don't avoid risk, folks. We manage it. The VectorVest stop loss is a very special calculation. It's loosely based around a 65-day moving average, but it's adjusted for the fundamentals RV and RS. If the fundamentals are good, and they're going to be, certainly when we buy the stock, the fundamentals are going to be good. They could deteriorate, but when we buy the stock, the fundamentals will be good. We widen the stop loss. We give that share more wiggle room. The VectorVest stop loss is calculated to weave that very fine line, folks, between keeping you in a winning position and protecting your capital. Now, those of you that have been at this for a while will know that before every decent move, the market will go back mystically and run 20-day lows. In fact, out at our Oxford group, we have a young man who was in tears for weeks. Some years back, a couple of years back, JD Sports made a huge move. And prior to that move, it came right back, a big tail on the candle, right back. He had a stop in the system. The stop was at an old low, far too obvious. And that's where the liquidity was. It was bid there. And the market went to the bid and he got stopped out. And then, of course, it made a 30% move. So the VectorVest stop loss is calculated to be out of the traffic, yet protect your capital. And it does that reasonably well. Those of you that have been at this for a while will know that stop loss placement is key. Because on quiet days, if you've got a share with great growth fundamentals, you'll find that those stops will get picked off. Don't get worried about that. That's just traders doing what traders do. They will do their best to get their clients in at a good price. Getting upset with them is like getting upset with a crocodile because he snaps at you, or getting upset with airplanes when they run late on a Friday, although I haven't been on one in a long time now. So we put a buy, sell, or hold every share in the market every single day. And this can certainly be used for entry points, and it most definitely is used for exit points. If I had more time, I would talk about the ability of our buy-sell ratio, the number of shares on a buy divided by the number of shares on a sell, to provide an early warning of a change in the overall market. And Dr. DeLito calls the buy-sell ratio the canary because of its ability to predict the future. But and certainly if you join VectorVest for a trial, then I'll be going through all of that in my Monday afternoon presentation. So it has got an amazing ability to predict the future. But we put a buy or a sell to every share in the market every single day. Now, for our worry-free strategy, folks, clearly the shares should not be on a sell. I want it to be on a buy or on a hold. So what we're going to try and look for are shares that are growing their earnings strongly, RV, safely, RS, that are rising in price, and they must be either a buy or a hold. I'll put in a liquidity requirement in a moment so that you can get in and out easily. We want to avoid shares that are poorly traded because if you do want to get out and manage that risk, that can be difficult. So those are the VectorVest metrics. Now, I want to go to the program for a second. And one of the problems with me being in London and my son, who's my technical aide. He's in Johannesburg. But if I stop share, James, I think I can share again. And I go to the program itself. And there we are. So that's the program. And I just need to get this out of the way. That's
Just
what.
a reminder, David, that you're now halfway through the session.
Oh, thank you, man. I told the lads from Master Investor a moment ago that in fact, I've always overrun. So very kind of them. I had a trading partner once upon a time. He's still my best friend, called Tom Hogarth. And Tom, in fact, would never go on after me because he never got any time. So the front page of VectorVest is all about the overall market. And that's controversial. I'm going to get there in a second. If I click on viewers and I click on stock viewer, with any luck, if this Zoom icon goes out of the way, we can see all of the shares and there's 2,063 shares that we follow in the UK. That's the LSE and AIM. I've loaded the top 50, so that's an overthrow from when the internet was poor. So the darn thing doesn't have to do all 2,000 calculations. The default sort is VST. So let's have a look at Cape Tech. It's the top stock. There's the code. It's on AIM. It's trading at 292. VectorVest believes it's worth 471. It was down a penny yesterday. Now, the penny clearly is not a proprietary number. You can get that from the standard for free. But this valuation is a proprietary VectorVest calculation. And as I say, if you go through Dr. Dolido's book, he'll show you how he gets that. Go away. RV is a whopping 1.62. Now, to refresh your memory, that's the share price appreciation potential in relation to what a AAA rated corporate bond will pay. So we have a share that's undervalued, a share that has got the potential to grow its share price enormously. RS is 1.16. On the scale between 0 and 2, that's fair. It is on the low side for a worry-free stock. It is on the low side. I like my worry-free stocks to have a RS of greater than 1.25. It would be perfect for a swing trade. So the RT, which measures the short-term trend, is 1.75. That's very strong. And when we put these three numbers together, we have a VST, which is the highest in the pack, 1.53. It's on a buy recommendation. There's the stop loss. And what I haven't, in fact, mentioned is the CI. The CI is a measure of the long-term trend. On a scale between 0 and 2, it's called the comfort index. And on a scale between 0 and 2, it's sitting at 1.28, telling us the long-term trend is good, the short-term trend is good. And this GRT is percentage annualized growth rate. It's on an earnings yield of 4.57, the PE won over it at 21.89. Now, if you go to the FT, you'll find that the FT have got different numbers, and that's because the FT are looking back, and this is our best shot going forward. So this stock looks absolutely great, but the RS is on the low side. Now, a bit later, we have a thing called Unisearch, which will allow you to input all the parameters you're looking for and automatically find stocks that suit your particular requirements. Today, our requirements are worry-free investing, but you can find them easily just by eyeballing the top 50 stocks. And in London, our group leader in London, a lady called Susan Thornborough, who's been running with VectorVest longer than I have, she started with VectorVest in Australia before she came back to the UK to take care of her mum. And she does it all from the stock viewer itself. She finds all her stocks, and my word, she invests well. And she tells everybody how she does that at our national user group, which meets every month. So in terms of meetings, you've got me on a Monday afternoon. We've got a national user group once a month. And we have what's called a Trending Thursday on a Thursday. And we have groups that meet all over the country. So if I were to look down at Alliance Tech, 888, as we can see, 888, trading significantly above the VectorVest valuation. Impacts Asset Management looking very strong, but trading above the VectorVest valuation. Lion Trust is a share. I'm a shareholder in Lion Trust. It's trading at 1570. We believe it's worth 21. That's good. Undervalued. My granddad told me the only way to make money in anything is to find the value of something and then pay less for it. He was a farmer. He was always buying more land. He was never content unless he was buying land. The RV is 1.5. The RS is 1.42. It's on an RT of 1.41. There's a great VST. And if I can get this go to webcast contraption out of the way, CI is a fair 1.18 and growth rate next year, 19%. Those numbers look impeccable, and it's a part of my worry-free portfolio. I've had that share since the market bottomed out last March, April, and I'm nicely up in that particular share. It went sideways for a very long time, and it's broken up to new highs. It's pulled back in the last day. Those of you that are technicians, it seems to have pulled back in what technicians would refer to as a bull flag. So it looks, if the general market goes, it looks as if it can move much, much further. I got to go back to my PowerPoint presentation. Otherwise, I'm going to run out of time, folks. But I could spend all afternoon going through stocks on the stock viewer. So share screen, go back to PowerPoint. How did that get back there now? I really don't know. I want to go here. So how to accurately determine market direction. Now, this is the controversial bit. We firmly believe that there's a good time to be in markets and an awful time to be in the markets. And the mantra is buying rising stocks with great fundamentals in rising markets. And when we say rising markets, we mean the overall UK market. And if it was a different afternoon, and we were talking about aggressive trading, I'd be talking about selling falling stocks in falling markets, but that's a story for another day. Dr. Bartolito says so beautifully that being on the wrong side of the market is the worst thing can happen to an investor. It doesn't have to happen to you. This was brought home to me by a story my dad told me. He told me that in 1969, the UK market made a high. It took 21 years, ladies and gentlemen, for the UK market to break that high. 21 years. The market peaked in 69. It went down. There was a bear market to 1981. And then in 1981, it moved up and moved up very strongly. But it took from 81 to 90 to break that high in real money. If you look at what's happened since 2000, the FTSE's above 7,000 this morning, but it's not that much higher than it was on the 1st of January 2000. But along the way, there's been some cracking moves. Down to 3, up to 7. And then from the March 9th, 2009, apart from the Euro crisis and apart from COVID, it's been moving up very strongly in this market, this run-up that's still going. So although the FTSE has gone nowhere in 21 years, there's been some cracking moves along the way, and we want to be on them. But everywhere you look, we're told that it's time in the market, not timing the market. And maybe if you're managing a couple of billion, that's the case. But if you're running a relatively small portfolio of £1 million or £500,000 or £50,000, there's no problem getting in and out at all, as long as you do your homework properly. And that's my metaphor for a stock market. I haven't been on one of these things in 40 years, but I can't imagine much has changed. They take forever to get up there, and then they fall very quickly. And that's exactly what happens in markets. Now, the front page of VectorVest is all about the general market. And we have market timing systems for spread bettors, okay, for medium-term swing traders, and for long-term position traders. And the long-term position trading model is called a confirmed call. Where's my pen? And on the software, you can see on the front page, there is a confirmed up. So some people love charts, folks, and some people hate charts. I love charts, and I can spend hours looking at charts, but some people hate them, and some people haven't got enough time to go through them. Many people find them very subjective, and that's for sure. It's charting is an art, not a science. But on the front page of VectorVest, we do our best to digitize market timing. And since the 11th of November last year, we've been in a confirmed up. Again, if I had more time, I could show you the construction of it. Okay, but I haven't. And I'll go through that in our Monday afternoon sessions. Now, this is the longest term measure of the trend on VectorVest, and this is the methodology that we use for our hands-off, worry-free investing to keep us in sync with the broad trend up. We're not talking about getting in and out every 2 or 3 days, because in the UK, as you know, that's difficult. There's a 0.5% stamp duty to pay, and the commissions are an order of magnitude higher than in the US, and the spreads are wider as well. What does this little traffic light do? Well, the traffic light measures the strength and the momentum of the short-term trend of the market. And for a reason to buy stocks, we need a confirmed up, and we need the momentum of the short-term trend to be strong. And we actually, one of our subscribers down in Cardiff, we were discussing what rules we would use to get into a position, and he came up with this solution. The solution to buy worry-free stocks, we need a confirmed up in place, and the short-term trend should be moving the same way. And you probably can't see it here, but it says VectorVest advocates buying safe, undervalued stocks that are rising in price at this time. My word, you can get very lucky when you actually just do what the darn thing tells you to do and get yourself out of the way. So in the next slide, that's the VectorVest composite. That's what our market timing is based upon. Now, the VectorVest composite is an equally weighted index of all of the shares that we follow on the UK market. To my best knowledge, I could be wrong, but it is the widest measure of the market that I know of. And superimposed on the chart are, I think you can see those green and red triangles. Those are our long-term confirmed calls, and that is the last buy signal here on November the 11th, and that is still current 6 months later. That was the buy signal after the dip on April the 21st from memory. That was a sell signal to run for cover in February. Now, in worry-free investing, folks, we want to be fully invested when the market is rising. Here, here, and here. When the market prints a confirmed down, no more buying. That's a signal to watch your stop losses and manage risk very carefully indeed. Sooner or later, ladies and gentlemen, I don't know when it's going to come, but it'll come. There will be a red triangle up here somewhere. Sooner or later, as markets are living entities, they breathe in like we breathe in, and they breathe out like we breathe out. When we get a confirmed down, it's a signal, no more buying. 2, it's a signal to focus on your stop losses very carefully and to manage risk very carefully indeed. Now, the high RS stocks are incredibly resilient. And in this little bit of turbulence here, this was caused, remember the second lockdown and whatever we had in November, the Kent's variant, I think we've all lived through it. And this came back a little bit. In this pullback, which lasted a fortnight, none of the high RS stocks came close to their stop loss. In this one, we were stopped out of everything. Everything. Now, that's only happened, that's the first time that's happened since 2007. That sell-off is the fastest and the highest percentage sell-off since 1915. The Germans felt that we were getting arms from the Americans on the Lusitania, so they sunk the Lusitania. So mostly on a confirmed down, you do nothing. You may get stopped out of a couple of positions. If you get stopped out of anything in a confirmed down, you build a cash position. So here, I was completely in cash going into here. In 2019, I'll show you the chart in a second, which was a really good year for VectorVest. This worry-free portfolio was up 45% in 2019. We traded twice. So we got out and we got into transactions. So there's not a lot of trading. And then, of course, in February 2020, we had to get out of the lot. So when you get a confirmed down, and you can see that on your app, VectorVest comes with an app on the Google phone, what's it called, the Android and the iPhone. You can see that confirmed up, confirmed down in your face in a second. So there's no excuse not to know whether the market is rising or falling. And let's face it, we spend half our lives with our faces stuck into the phone. So there's absolutely no excuse. Once you get a confirmed down, well, you're on high alert, folks. You don't know whether it's when we get one up here, and we'll get one as sure as I'm sitting here. When you get a confirmed down, you don't know whether it's one of these or one of these. So we're on high alert, watching our stop losses very carefully. So how do we put this all together? I know I'm running out of time. Well, Unisearch will find those stocks for you. Susan Thornborough has made a different stuff. She actually finds them by just looking at the stock viewer. And Unisearch can do searches for fundamental and technical issues. So if you want to find when two moving averages are crossing, or you want to find when the MACD turns up or the stochastic goes up through 20 or something, then you can do all of that easily. Folks, the objective is to find the very, very best stocks, those stocks that can grow earnings strongly and safely. And good portfolio management starts with buying the right stocks. That's a quote from Dr. D. I've tested this, and these days I'm testing it going forward as opposed to going back. And the key is relative safety. And relative safety is a function of earnings, company size, price behavior, how long the company's been around, dividend history, and all those ghastly financial ratios, although the only one that I brought into my own work was the debt to equity ratio. That's the little search. As you can see, it sorts, and this is pre-written on VectorVest, it sorts everything by relative safety, and it's looking for an RV of greater than 1.25. Share shouldn't be on a sale. That double R means not. It should be above 50 pence. And I put in a volume requirement of 50,000 shares as measured by a 50-day moving average of the share. We use the confirm signals to get in and out. There they are. And as I say, when we've got a confirmed up, we want to be fully invested. When we've got a confirmed down, don't buy. Watch your stop losses very carefully indeed. If you do get stopped out, build a cash position. When you get the next confirmed up, back to being fully invested again. You learn when you manage money for somebody else that if you're not fully invested when the market is rising, that you're not going to outperform the market. Simple as that. So you have to have the strength to be fully invested when that thing is rising. And sometimes it's not easy to get in at the bottom, because when it's the right time to buy, ladies and gentlemen, you won't want to. Just think of your mood last April. So from last April, our confirmed up was on the 27th of April. And the portfolio hasn't changed at all. We weren't stopped out of anything. And that portfolio was up 50% in the year. The market's up 32. It was a great year, but we've outperformed the market. As you can see, no losers. And that's to last night's data. Since November, we're up 17%, which is 37%. And that's the beauty of this strategy. There's been no work at all. And I pretty much guarantee that all those people looking at screens all day, every day, haven't made 37%. And the spread bettors say that most of those guys, 70% of them lose money. So letting the ball do the work and ignoring the noise pays a great deal of dividend. That's 2019. There was one bad one here, Pearson. Clearly, we should never take a 37% hit. But in 2019, the portfolio was up 48%. But as I said a second ago, I gave 16% of that back in February. And I was glad that I gave it back. That's the equity curve on 2019. 2019, we traded once there. There was a confirmed down in August. We got stopped out of 2 of the 10 shares there. Got back into them at the next confirmed up, held them right into the end of the year. So I've tested this over 20 years in the US. That's 2000 to 2003. That's the crisis. That's the Euro crisis. And that's to 2006. Since 2016, should I say, since 2016, I've been testing it going forward with real loot. And I, in fact, I report on that every Monday afternoon, as I say, good ones and bad ones, mistakes. I make mistakes like everybody else. This has gone up significantly since that. That's a 17% compounded rate of return. And with VectorVest, folks, you can run that test easily. Now, there's no dividends in that. I haven't added in the dividends. The program doesn't allow us to add in the dividends. So if you'd added in the dividends over that 20 years, then you'll find that it just shoots up through the roof. You can't really fathom the power of compounding. It always amazes me. So you might be wondering how you're going to do this for yourself. And I've got a plan. That was me, folks. I tried to keep the fundamentals under control. I couldn't. I went to South Africa to play rugby. And I played provincial rugby. When I started this in the 80s, we were playing to 60,000 people every Saturday afternoon. It was a magnificent time in my life. I didn't have the time. I didn't have the inclination. I didn't have the skills to actually fight with the annual reports. So for many years, I was a technical trader alone. And then I tripped over VectorVest. I was so impressed with it. I got the South African business, and VectorVest, in fact, does all the fundamentals for me and gives me the fundamentals as a trader, as an investor, in a format that I can easily react to. And that's important. Information is absolutely useless unless you can react to it. So to break out, I've got a plan, as you probably suspected. And I put together a little course which is built into VectorVest. How to analyze stocks quickly and easily, separate the good from the bad. How to get rid of the bad ones. How to know when it's safe to buy. And what to buy, of which cherry picking checklists. One of them is worry free and the other ones are more momentum orientated. And then the last is a plan to put this together. Now in the States, they charge a fortune for that. But if you roll your sleeves up and work with me for the next 60 days, we'll go through this and it's £5.95, folks. The code is vectorvest.co.uk/MI. Now, it normally comes with 30 days access to VectorVest, but because Master Investor and ourselves are such good mates, we're going to make that for you. If you click on that link, it'll take you to a 60-day offer. So for the £5.95, you're going to get my course. You'll have access to that for 60 days. It's a well-presented course. You're going to have access to VectorVest World for 60 days, which is UK, US, Canada, Australia, and the whole of Europe, apart from Scandinavia. So after the 60 days, folks, if you want to continue, it's £49 a month. If you don't want to continue, then you simply stop it. As I say, we're fully authorized by the FCA. That cost a fortune. And I assure you that we're not going to give that away for £5.95. So in my 10 years working with VectorVest, there's never been a problem with any form of credit card, any form of refund. We want you to be a customer for the next 30 years. So we have weekly group coaching. There's myself on Mondays, Glenn Tompkins on a Thursday, and our user groups, national user group online, and our groups around the country. We have an 0800 number that gets you through to our call center. It's open from 12 o'clock midday to 12 o'clock at night. That telephone call is free, or Mahala in Zulu if you're interested. And that's your first protocol. And we've got lots and lots of people who've done this. This is Tom. He's a farmer from Somerset, and the wonderful part of the world in North Somerset. He tells me he's finally got a written plan after all these years. He's been in the market for 30 years, and for 30 years, he's consistently been buying the top and selling the bottom. When it's time to buy, folks, you won't want to. When it's time to sell, you won't want to. Okay, so if you're interested, we can offer you a 60-day trial. If you go to the website, it's 30. Then you've got 60 days to evaluate to see whether it's for you or not. After the 60 days, then it's £49 a month. It's on a month-by-month basis. There's no contracts. My promise to you is that if you don't think it's the best £5.95 you've ever spent, then you can have that back with the greatest of pleasure. And clearly that should be a 60-day money-back guarantee. Okay. So folks, that's me all out of air. So I hope you've enjoyed the presentation. I could expand that out into 3 days if I wished. And those of you that don't know that I could talk about it for 3 days don't know me that well. James, over to you, sir.
Thanks very much, David. I'm sure we could all listen to you for much longer, but hopefully we can get you back at some point. Yeah, unfortunately, we don't have any time for questions, but we'll collate those and get those over to David separately. Do check out the special offer for Master Investor viewers, and you'll get the link in the follow-up email, and also the survey, which we'd be delighted if you can spare a bit of time to reply to. So the next webinar is on the 13th of May, and that's at 12 p.m. and that's a Q&A with Evil Knievel. So that's always a good laugh. So do join me for that one. And then, yeah, just to say thank you all very much for attending, and thank you to David for presenting. So thank you very much.
Thank you, guys. It's been great. Thank you.
Thanks, everybody.